At 30 years old, Jimmy started buying dividend stocks. $500 a month, boring companies, nothing exciting. And then he did the one thing almost nobody does. He never sold a single share. Not in 2008. Not in 2020. Not when his friends were tripling their money in tech stocks and calling him a grandpa. 35 years later, Jimmy is 65. He owns $1.47 million in stock, and every month a deposit lands in his checking account for $3,677 that he did not have to sell anything to get. That number goes up every year for the rest of his life. He will die owning every share he ever bought. Now here's the part that's going to bother you, and I'm going to be completely honest with you about it. His friend who bought a plain index fund instead ended up with $427,000 more than him. More money, less income. And by the end of this video, you're going to understand exactly why that trade might be the best deal in personal finance, and why a third guy, who bought the exact same dividend stocks Jimmy did, ended up with less than half of what Jimmy has. He made one small mistake, and it's the mistake almost every new dividend investor makes in their first year. Let's start with what a dividend actually is, because a lot of people nod along without really getting it. When you own a share of a company, you own a slice of that company. Some companies keep every dollar of profit and reinvest it. Other companies, usually older, steadier, deeply profitable ones, send a piece of that profit directly to the owners, for times a year, in cash. That cash is a dividend. You don't sell anything. You don't do anything. You own the thing, and the thing pays you. It's the closest thing in public markets to owning a rental property where the tenant never calls you. And there is a very specific flavor of this that matters. Not just companies that pay dividends, but companies that raise them. Every single year, there's a group inside the S&P 500, fewer than 70 companies out of 500, that have increased their dividend every year for at least 25 consecutive years straight. Through the dot-com crash, through 2008, through a global pandemic, raised it every year. That's not a marketing gimmick. That is a company publicly betting its reputation that its profits will be bigger next year than they were this year, and doing it 25 years in a row. Now, does that actually produce returns? Here's the receipt. Ned Davis Research, tracking every S&P 500 company from 1973 through 2025, 52 years. Companies that grew or started dividends returned 10.22% a year. Companies that paid no dividend at all returned 4.21% a year. $1,000 in the dividend growers became $17,375. $1,000 in the non-payers became $888. It lost money over 52 years. And the dividend growers did it with lower volatility, a standard deviation of about 16% versus almost 22% for the non-payers. Higher return, smoother ride. That is a genuinely rare combination. So let's run Jimmy's actual numbers, and I want to be conservative here on purpose. Jimmy is 30. He puts $500 a month into a portfolio of dividend growth stocks. 2 rules, and he never breaks either one. Rule 1. Every dividend gets automatically reinvested. It buys more shares the day it lands. Rule 2. He never sells. That's it. That's the entire strategy. For the return, I'm not going to use the 10.22% from the study. I'm going to use 9% because I'd rather be too pessimistic than too optimistic, and 9% breaks down cleanly. About a 3% dividend yield, plus about 6% a year of share price growth as those dividends grow. $500 a month, 9% a year, compounded monthly for 35 years. Jimmy contributes $210,000 of his own money over those 35 years. That's the whole cost, spread across half his life. And at 65, it's worth $1,470,867. $1.47 million, which means $1,260,000 of that was never his money. It was the market's money and his own dividends buying more shares on his behalf, quarter after quarter, for 3.5 decades. But the pile isn't the point. Here's the point. That portfolio yields about 3%. 3% of $1.47 million is $44,126 a year, $3,677 a month, in cash, arriving whether the market is up, down, or on fire. He has not sold a share to get it. And because those companies keep raising their payouts, that check isn't flat. At 6% dividend growth, his $44,000 becomes about $79,000 a year by 75, and about $141,000 a year by 85. His income chases inflation up the stairs without him touching the principal. Now let me show you the single most underrated number in investing. It's called yield on cost, and once you see it, you can't unsee it. Forget what the portfolio is worth today. Go back to Jimmy at 30, in his very first year, buying $6,000 of shares at a 3% yield. That $6,000 paid him $180 that year. $180. Underwhelming. Now let those companies do what dividend growers do. Raise the payout about 6% a year, and fast forward 35 years. Jimmy still owns those exact same shares. He never sold them. And that original $6,000 is now paying him $1,383 a year. On $6,000. That is a 23% annual return, in cash, on the money he put in at 30, before you count a single dollar of the share price going up. 23 cents a year, forever, for every dollar he invested 35 years ago. And that's just year one's money. Year two's money is doing almost the same thing. So is year three's. Every batch of shares he ever bought is quietly climbing its own yield-on-cost ladder in the background. This is why they never sell. Rule isn't stubbornness, it's the entire mechanism. The day you sell a share, you don't just lose the share, you delete every future raise that share was ever going to give you. You fire a tenant who was scheduled to raise your rent every year for the rest of your life. Okay. Time for the part most dividend videos will never tell you, because it's not flattering. Jimmy has a friend, call him Jimmy 2, who did something much simpler. Same $500 a month, same 35 years, same discipline. But instead of dividend stocks, he bought a plain total market index fund. It yields barely over 1%, so it produces almost no income. But it holds the fast-growing companies that pay nothing at all. And historically, that broad basket has returned closer to 10% a year. Run the exact same math at 10%. $500 a month, 35 years. Jimmy 2 ends up with $1,898,300. Jimmy 1 has $1.47 million. So Jimmy 2 is ahead by $427,433. Let me say that clearly, because I'm not here to sell you a strategy. On total wealth, the boring index fund beat the dividend portfolio by more than $400,000. That is what it costs to buy a lower volatility, income-producing portfolio. It's a real cost. It's not a rounding error. So if the only thing you care about is the biggest possible number at 65, the index fund is probably your answer, and you can stop the video here. But almost nobody's actual goal is the biggest number at 65. Your actual goal is to spend that money for 30 years without running out. And that is a completely different problem. Here's the difference. Jimmy 2 has $1.9 million in an index fund yielding about 1%, so it hands him around $22,000 a year without touching anything. He needs more than that to live. So to get to Jimmy 1's $44,000, he has to sell shares. Every year. Forever. And selling shares to eat is a fundamentally different risk than collecting cash to eat. It has a name, sequence of returns risk, and it's the thing that actually bankrupts retirements. Watch what it does. Suppose the market falls 50% right after he retires. Now his $1.9 million is $950,000, and he still needs $44,000 this year. So he sells twice as many shares, at the bottom, to raise the same grocery money. Those shares are gone. They don't participate in the recovery. He has permanently converted a temporary price drop into a permanent loss of ownership. And if the drop lasts a few years, he sold off a chunk of the engine right when it was cheapest. Now put Jimmy 1 in the exact same crash. His portfolio also drops 50% on paper. But here's what actually happened in the real 2008 and 2009. Prices across the market fell more than half, and dividends fell about a fifth. Prices collapsed. The cash payments mostly kept coming. Jimmy's check might have gone from $44,000 to $35,000 for a year or two. Painful, but he sold nothing. He owns exactly as many shares on the other side of the crash as he did going in, every one of them still on its raise schedule, and his reinvested dividends were buying those shares at half price the whole way down. Same crash. One guy is dismantling his portfolio to survive it. The other guy is quietly getting a discount. Which brings me to the third guy, and the reason I made this video. Jimmy 3. He read all the same stuff. He bought the exact same dividend stocks on the exact same day, $500 a month, for the exact same 35 years. Identical portfolio. He made one change. When the dividends showed up in his account, he spent them. Not on anything crazy, dinner out, a car payment, a vacation. It felt like free money. That's the whole point of dividends, right? Passive income. So he took it. Here's what that did. Without dividends buying new shares, his portfolio only grows at the price growth rate, about 6% instead of 9%. Same $210,000 contributed. Same 35 years. Same companies. He ends up with $712,000 for $150. Jimmy 1 has $1,470,000. The gap is $758,417, and Jimmy 3's dividend check in retirement is $21,000 a year instead of $44,000. Half the income, half the estate. And what did he get for it? Roughly $240,000 of walking around money spread thinly across 35 years, a couple $100 a month early on, a few hundred later. He traded $758,000 and half of his lifetime paycheck for that. So here is the rule, and it is the single most important sentence in this video. Dividends are not passive income while you are building. They are fuel. They only become income the day you stop reinvesting them. And that day should be the day you retire, not the day you get your first $31 deposit and feel like a landlord. The button that says reinvest dividends automatically is worth $750,000. Go turn it on. Let's land it. $500 a month from 30 to 65 into dividend growers. Every dividend reinvested, nothing ever sold. $210,000 in. $1.47 million out, throwing off $44,000 a year, $3,677 a month. That rises about 6% a year and never requires him to sell a share. For things to take with you. 1. Dividend growers beat non-payers by 6 full percentage points a year over 52 years, with lower volatility. This is not folklore, it's a 52-year record. 2. The honest trade-off is real. A plain index fund likely leaves you with more total money, and you should only give that up on purpose, in exchange for income you don't have to sell to receive. 3. Yield on cost is the whole game. The shares you buy today are still paying you raises in 35 years, so selling doesn't cost you a share, it costs you every future raise that share owed you. And 4. Reinvest every dividend until the day you actually need the cash, because spending them early cost Jimmy 3 $758,000 and half his retirement income. So tell me in the comments, are you team dividends or team index fund? And be honest about why. And here's the real question I want answered. If you're already investing, is your dividend reinvestment switched on right now? Or have you been quietly collecting $30 a quarter and calling it passive income? Go check. Actually check, don't guess. If this changed how you look at that little cash balance in your brokerage account, hit like, subscribe for a new What If Money breakdown every week, and send it to the person you know who is absolutely, definitely spending their dividends. I'll see you in the next one.